Right traders, welcome back to the channel. Here we have the GBPUSD chart in front of us, or the GU chart in front of us, and we're going to be going over a counter trend sell trade to the downside, right? So again, what we have over here is we have the 4-hour time frame, and just to begin, we mark out our higher time frame structure. So what we had over here is we had a structural high. So a 4-hour structure is typically labeled in orange. So what we have is we have a structural high. We have a structural low down here. We have price giving us a structural high. So if we fast forward to most recent price action, what we have over here is we have a dealing range, where what we've seen is we've seen price giving us a low over here down here, so a lower low, a higher low, and now we've had a lower low that's been engineered all the way down here. And so from here, what we see over here is we see a couple of things. We understand from the last video, I highlighted the fact that we've had a break of structure. So the thing to understand, the underpinnings to understand from this is that we have a bearish break of structure to the downside. So I'm going to label that as a break of structure. So we understand that our structure is bearish. That's the first thing to understand. The second thing to understand is that we have a dealing range to work with. So our dealing range, quite simply, can be projected and can be shown simply using the Fibonacci tool, right? So we have the Fibonacci tool from the swing high. We project the Fibonacci from the swing high down to the swing low, and so this gives us two distinct regions to work with in the market, right? What we have over here is we have anything above being a premium, anything above being a discount. So the way that I built out my narrative initially to begin with is we need to understand that I am now showing you a POI that's been selected just over here in this region, right? So we have a POI just over here. So quickly, what makes this a POI? Why is this a valid POI according to the rules? So what makes this a valid POI is simply because it follows 3 of the basic price action rules, right? It's a 4-hour POI, and so what makes this a POI is the fact that we see price breaking structures to the downside, we see price in a premium, and we see prices left a fair value gap, right? We've left a fair value gap just over here. So this here is a fair value gap that's pretty obvious to see, and so with these 3 things, this POI now becomes a target. So the overall narrative for the markets as we speak right now, so the date recording 9th of May 2024, the overall narrative of the market is to see higher prices up to at least this POI over here. So I expect price to get up to at least 1.2669, right? 1.2669 roughly. That's the overall pricing. So this is the 4-hour time frame and a higher time frame that we use at Liquid FX to build an overall bias. So we need to understand right now that we are in a discount, and this is the discount range over here, right? So what we see over here is we see a discount, and so typically when we're in a 4-hour discount, what we want to see is we want to be seeing buys from discount up to premium. So we want to see something just like this, right? And we're looking to buy up the accumulation, right? So once we've broken a low, so this is a 4-hour low, once we're below the 4-hour low, we've broken structure. What we expect in this region over here, this large kind of region over here, is we expect price to give an accumulation, right? So this is Wyckoff concepts, right? So anything below an old low, we expect to see an accumulation. We expect higher prices when we're below the low. So accumulation below the low. So this is basic SMC concepts or basic Wyckoff concepts. Anything below a whole old low, 4-hour low, daily low especially, we expect an accumulation or a Wyckoff accumulation. And that's what we've seen over here. This is what price has given us. And so for me, the overall bias is bullish, but we're going to be going over a counter trend trade to that. So you can trade pro trend and counter trend towards the higher time frame. And here's how we do that, right? So in order to trade counter trend, we want to go down to the lower time frames, i.e. the 15-minute time frame. So again, what we have here on the 15-minute time frame, if I quickly mark out the structure for you, again, we have quite simple structure over here that It's quite self-explanatory once you've practiced structure a little bit. So again, what we have over here, if I picture, is we have price giving us a structural high over here. We have price giving us a structural low, and we have price now giving us a structural high. And so from here, we're dealing between two regions over here. So what we have over here is we have a structural low and we have a structural high, just like this, right? So again, we understand our structure is bullish, and so we use the simple arrow tool over here to mark that out. So we have a bullish breaker structure over here. This is the first thing to understand. We have a boss or a breaker structure to the upside, right? So this gives us our structure in the markets. Now from here, we have a dealing range to work with. So what is that dealing range and how do we identify the dealing range? Well, the dealing range is essentially the lowest is the low to the high, the most recent low to the most recent high. And what do I mean by that? That simply is this projection over here. So this large projection over here is essentially that dealing range that we want to be working with. Now, once we've identified the dealing range, right, we understand we have an equilibrium. So this equilibrium is the 50% level here, and anything above that is the premium. And that is the bread and butter to this particular case study. We are selling in premium. And from premium, we are targeting the discount because we understand that's how the markets work. Markets move from premium to discount, discount back up to premium. That's sort of the bread and butter as to how the markets work. So to quickly dissect this trade in a little bit more detail, we're going to have to zoom into the price action from Friday the 3rd of May 2024, because this was essentially a post NFT trade, right? Post NFP trade, sorry, not NFT, NFP trade, sorry. So again, what we have over here is we have price giving us an Asian range to work with over here. So we have an Asian range over here. So this here is an accumulation of the market, right? So this here is a phase or a session that builds liquidity in the markets, and it's typically a low volume time of day. Although on Friday we did see a little bit higher activity. So what this typically means is that we should avoid the London session. So this is a quick ICT tip for everyone. When you see an Asian range that's not consolidating, like this Asian range over here, this Asian range over here, or this Asian range over here, when you see an Asian range that's a little bit more active, what you typically want to do is you want to avoid the London session. Avoid the London session. So this day, there were actually two reasons to avoid the London session. The first was the fact that we had NFP, right? So NFP is a very volatile news event, as a lot of people know, and you shouldn't be trading that. You should be trading the reaction after NFP is finished. So when you have an Asian session that's quite high volatility, in this case, it's better to avoid that London session. So again, what we have over here is we have the larger wick to the upside, which gives us the NFP move over here. This was essentially the NFP move over here, right? So again, this was Friday the 3rd of May. And again, what's important to understand is that the high of the week typically forms on a Thursday or a Friday. Now, if it's NFP, that high of the week can be extended to the Friday, but typically from using the weekly cycle, the high of the week is formed by Thursday. But you need to understand once Thursday or Friday is kicked in, it's a very high likely possibility that we're going to be seeing the high of the week, right? So this here was in fact the high of the week, and that's exactly how the trade itself was called. So the high of the week, right? HOTW, right? High of the week was established during that NFP move. So during this NFP move, what we had over here is we had, of course, quite an aggressive breaker structure to the upside. Again, we had a high over here, and the NFP gave rise to a breaker structure as well as a liquidity sweep, right? It acted as both a liquidity sweep and a breaker structure to the upside. And so we understand from basic SMC concepts that the whole idea of the market is to essentially sell above old highs and buy below old lows. That's exactly what you have. This is exactly the principles you want to be taking into the market in the first place. Buy below old lows and sell above old highs, right? This is one of the classic basics that you can use in your ICT and SMC style trading, and it allows you to get onto the right side of the market more often than not. And so once we've established that, we're simply now looking for a basic AMD model, right? So what we see over here is we see an accumulation. The Asian range going into London, especially for an NFP day, is an accumulation. Now the manipulation itself was actually the NFP move, right? The NFP move is what gives you the manipulation of the market. That's essentially what gives you the M in that AMD model. So this is the manipulation over here. Again, what validates the manipulation? What validates the ICT Judah swing? Because the manipulation is the Judah swing, right? This is a common misconception I get with a lot of students. The AMD model, right? The Judah swing corresponds to the manipulation. So this here is an ICT Judah swing, right? And so once you've had an ICT Judah swing, again from here, the next thing to validate that Judah swing is essentially we've had a break of structure to the downside. So if we quickly mark out the most basic structure, we have a structural low, down here, structural high, structural low. NFP gave that structural high all the way up there. And so from here, this is our clear break of structure just over here. So this is very simple shifts of market structure from bullish down to bearish. So this now is going to be our break of structure, right? So this arrow here represents the break of structure. So again, where do we want to enter off as a trader? So we've had our accumulation just over here. We've had our manipulation. And so from here, our job is to trade the distribution. Again, it's very simple from this point. This is a simplified 15-minute entry model, right? So the lower time frames I don't typically go into, so that's typically just safe for the members, but you can still apply the lower time frame logistics onto the 50-minute time frame, onto the hourly time frame, and it's simply keying off the correct fair value gap, right? Fair value gaps exist everywhere, right? It's building the narrative and the story and keying off the fair value gap. So again, what we have over here is we have a fair value gap. And so this fair value gap occurred at 3 p.m. UK time, which corresponds to that New York session, right? So this is in that New York session, right? New York session post NFP. If there's one thing you take from this video, it's to understand your trading after NFP, not during NFP, because that's not trading, that's gambling, right? So you want to trade the reaction in line with all the other concepts, right? And the simple concepts rely on accumulation, manipulation, and we're now looking to sell during the bearish distribution. And how we do that is quite simple. We key off the fair value gap over here. So this here is a fair value gap. And so our job is to key off the fair value gap, right? So we have a fair value gap over here. Again, stop loss above that Judah swing, high, just like this, just like that. And so our job now is to target the fair value gaps from below. So we had a fair value gap all the way down here. If I quickly label that so people can see that. This is our discounted fair value gap, right? So this now then becomes what we call an M15 POI. Some people refer to this as a POI. Some people call it a liquidity grab or liquidity void, or whatever you want to call it. This here now is a 15-minute POI or a 15-minute fair value gap, right? 15-minute fair value gap is what I like to call it. And what makes this an extremely valid and high probability fair value gap is the fact that it is priced in deep discount, right? This is a deeply discounted, if I can spell, this is a deeply discounted POI, right? This is what makes it a high probability. So if we quickly just drag this to the right, we understand price eventually did get down here and we target this 15-minute POI, right? Just like that. So again, we had a premium sell. So we started from premium and we head all the way back down to discount. This gave us a 1 to 1, I believe, depending on where your stop loss was. You can either have your stop loss here. I believe I had my stop loss slightly below. I think I had it in the middle of the wick. So I just had about 1.3, 1.4 R. Again, it was a swing trade, intraday swing that was held overnight. So again, giving your trades enough stop loss, enough room to breathe is essentially one of the main lessons as well when it comes to understanding the markets and how it works. An intraday swing trade that could have been taken post NFP, riding it down Monday and Tuesday. Quite an easy trade if you understand what you're looking for, using the simple concepts of accumulation, manipulation, and distribution.